Holy moly, this one is worth breaking out the Christmas suit for because the United States government was just downgraded. This time by the biggest credit rating agency of them all, or at least the most respected out of them all. The only firm that has never downgraded the US. Just did. Does this mean bad things are coming next for markets? Back in 2011, when Standard & Poor's cut the rating of the US government, stocks fell about 7% the next day. Like the next day. Not within the course of a month, like 24 hours later. So, how does that set up our markets this time around? What do you need to know and what is important? Am I all of a sudden bearish? Should you be bearish? Or is this, again, another non-event? We're going to go ahead and get into it here in this video. Do me a quick favor and hit that like button as well as subscribe to the channel because they are, as you guessed it, free 99. And let's get into it. So let's go back to a little bit of history. The last major downgrade you've seen that was a big event for our markets was obviously in August of 2023. Fitch downgraded the US, and we'll talk about that here in just a second. But the big one was in 2011 from S&P. They downgraded the long-term credit rating from AAA, representing a risk-free rating, to AA+ as early as 2011, citing political polarization after another debt ceiling squabble in Washington. Then Fitch did the same thing 12 years later. On August 2nd of 2023, Fitch downgraded the US economy to AA from AAA. Fitch's explanation for the downgrade was that it, quote, reflects the expected fiscal deterioration over the next 3 years, a high and growing general government debt burden, and the erosion of governance relative to AA and AAA rated peers over the last 2 decades that has manifested in repeated debt limit standoffs and a growing fiscal problem. Let's just call it that. All of these downgrades recently, well, I should say 2 of the downgrades we've seen recently within the last 6 months or so, are because of the government. They are spending like they are drunk. I don't think this comes as a big shocker necessarily. There's 2 things you really need to know about a government downgrade. There's the rating, AAA, AA, A, triple B, double B, B, and then you get into just where you don't want to be after that point. Really, you want to be in the A's, like AA or AAA. That's where most of your developed world is. Now, just like a stock, how an analyst will give it a hold rating, a neutral rating, a buy rating, an overweight rating, a sell rating, an underperform rating, you get something similar with governments as well. It's along the lines of neutral, negative, stable. That's important as well as just the AA or AAA rating. It's also important to consider some rating agencies are seen as more important than others. You could make the argument that S&P is the most important, Moody's is a close second, and then Fitch is like your third tier. Fitch downgraded the US again on August 2nd of 2023, and nobody really batted an eye. And now, for the first time ever, Moody's has cut the rating for the United States government. This article says Moody's cuts US outlook to negative, citing deficits and political polarization. Sounds very similar to what we just discussed and the other downgrades that we have seen from Fitch and Standard & Poor's. Moody's Investor Service lowered its ratings outlook on the United States government to negative from stable, pointing to rising risks to the nation's fiscal strength. They're basically saying in English, you're spending too much money. Your debt service payments in 2024 are larger than your military expenses because the Fed has been raising rates. That's a problem. as the government debt has continued to grow, now at almost $34 trillion, there's a big difference when rates are 5.5%, 5% on 10-year treasuries, 4.5% on 10-year treasuries, whatever the rate is on any given day, or when 10-year treasuries are at 1 or 2%. That makes a big difference. In theory, that more than doubles your interest payment. And if you continue to spend like you are drunk for many years, the ultimate outcome to that is never a good one. But this downgrade from Moody's was a little bit different. So this says the ratings agency has affirmed the long-term issuer and senior unsecured ratings of the U.S. at AAA. So unlike Standard & Poor's, unlike Fitch that lowered the U.S. from AAA to AA+, Moody's holds their AAA rating. They did not downgrade the actual rating itself. They just said the outlook looks negative for the U.S., at least until 2025. So I'll tell you right now, there's absolutely 0% chance that this could be good for markets, but if it is not really negative, it's because of that. They didn't cut the actual rating itself. Let's be honest, just on August 2nd, when Fitch lowered their rating, again, I would say the least respected rating agency out there, stocks still fell 2.2% on the NASDAQ the following day. So it was not a good outcome. And I would argue that this downgrade from Moody's is even worse. Although they didn't change the credit rating, it is going to have a big effect on our markets. That is pretty much a certainty. So the last time we were downgraded, we fell 2.2%. The time before that, back in 2011, well, the NASDAQ fell about 6% the following day. So it was even worse back in 2011. And specifically, the US was downgraded on August 8th, 2011. You were already falling before this, and that was kind of the last dagger in the coffin, if you will. During this 2.5-week stretch or so, stocks on the NASDAQ, your triple Qs, fell about 16.5%. The last Fitch downgrade did cause the NASDAQ to fall about 6.6%. If you want to count the lows that we just seen, you fell about 10% from the point in which you were actually downgraded. So I can't imagine a different outcome besides something in that range. But again, it's not a guarantee. We didn't get the actual rating downgraded, but there's one big reason why stocks fall following a downgrade. And this is the only thing that really matters. In simple Google terms, when an issuer of debt has its credit rating downgraded, that often means it has to pay a higher interest rate to compensate for the potentially higher risk of default it poses. So on top of the almost $34 trillion worth of debt and the interest rate on yields being in between, 5%, maybe 4.5% now on the 10-year treasury, a lot of debt's going to be maturing over the next year or two, and all of the new debt that is being issued today to fund the government's initiatives, which was like $2 trillion that had to be issued from around August of 2023 to the first quarter of 2024, a lot of debt has to pay these high interest rates. Well, if investors just don't want to own the debt even more now because now you just got downgraded by Moody's, that means in simple terms, bond yields could rise and rise a lot. And that's your bare minimum expectation. Bond yields are going higher. Does that cause stocks to fall? Well, the correlation that we have seen recently is yes. This could, on the other hand, cause the Fed to U-turn in a big way, depending on what bond yields do. The Fed doesn't want to admit it, but inflation is essentially conquered. If you strip out housing, then inflation's basically gone, right? There is a chronic problem in housing that the Fed knows about, you might know about. If you don't, you're about to learn. Basically, anyone in the financial world that knows anything about anything knows this. There is a chronic problem of supply and demand in housing. You are building less houses today every year than you did in 1960 when the United States population was 160 million people. The last census that was done, there was over 340 million people living in the US. That's not to mention, whoever knows how many people have come to the country in the last couple of years, it's probably pushing, 370, 380 million people by now. That wouldn't surprise me. And we're not building enough houses. So you're just not going to fix the problem by raising rates. That's not how these things work. The government's going to be at this point, if yields go higher again, they're going to have to pressure the Fed to lower rates because it's literally unaffordable to pay these rates with such a high debt burden. But not just that, it could put unwanted pressure on the economy. See, if inflation is really only in housing anymore, and you're seeing disinflation everywhere, and raising rates is not affecting housing, then you have way too much pressure on the economy. And that's what the Fed just said during the last press conference. They said if stocks fall, if the dollar rises, if bond yields rise, that could cause the Fed to change their policy path. That's literally what they said. For the first time ever. They've never said that before. Ever in recent times. And the Fed did. And I think that set us up for a U-turn, and that's why stocks have been going higher. So that is the potential bullish-ish outcome. This could put more pressure on the Fed to cut rates sooner, especially if we get a weakening economy and a bad inflation report next week. By bad, meaning a low inflation report. Now let's get to the bottom line of this. Is this bullish? Is this bearish? Does it not mean anything? How am I thinking of this? It's pretty simple. Well, it's definitely not bullish. Historical precedent is for a subsequent couple month period of weakness for markets in between 6% and 16%. Take your pick. Probably, anywhere in that range could be expected. Now, this was a little bit different because Moody's did not lower the AAA rating, but it essentially does the same thing. It's going to cause bond yields to rise. That's why stocks have always reacted negatively to this. It's not that the U.S. is actually going to downgrade. We'll print our way out of it if we had to, right? And just cause more inflation. That's what the government would do, right? We're not going to default. No way. But it will make yields go higher. This could have a short-term bearish reaction followed by a bullish reaction when the Fed does U-turn. This is another block on the broken roof, if you will, of the Fed's house. The Fed's house is already leaking water. It's already got a roof that's like 35 years old, and you've just added another pallet of bricks on top. That's essentially what this is. So it's probably going to force the Fed to U-turn quicker than they otherwise would have. And I think that will be taken as bullishly. So short term, next couple of weeks, it depends how the inflation report comes out. But this is definitely not good. The precedents of these events are really bad. But I do think it maybe means we hit that bottom a little bit sooner and ultimately can really see a broad market rally. Let me know what you think about all of this information down below in the comment section. Hit the like button and subscribe to the channel on your way out of this video. Thanks for watching. Enjoy the rest of your day, and I will see you in the next one.